Hey guys, my name's Jose, and this is another episode of Buy or Pass. In this series, I will look at financial documents of a company and decide if I had money, would I buy or would I pass? Before we start, don't forget to hit that subscribe button to make sure you get updates on new episodes and other videos. So let's begin. Like always, I will use a website known as lazyfa.com, which allows me to see all this information in easy visual data. Today, we're going to take a look at FedEx. So that's ticker FDX, I'm pretty sure. So let's take a look at FedEx. So the income statement, when we take a look at the income statement here, we're going to take the revenue, which is the sales they did, the cost of revenues, their gross profit, which is the difference between the revenue and the cost of revenue. And we're also going to look at their net income. Those are the four things I want to look from here. So we can see from revenue from their annual records that every year since 15 they have increased. So from 17 to 18 it increased from 60 billion to about 65 billion. So close to 8% increase in the year. Not too bad. It's good to see revenue increasing. Another thing we see increasing though is cost of revenue, and it's increasing pretty it seems to be increasing at a higher rate than revenue. From 16 to 17, it went from 17 billion to 22 billion, and then from 17 to 18, it went from 22 billion to 24 billion. Close to that 8-9% as well as revenue. So they seem to be increasing by 1-to-1 ratio, which is not that great. I would prefer to see revenue increasing at a higher rate. Gross profit, we can see gross profit has been increasing, but it does seem like this year the growth percentage has not increased as much as the previous year. Right, from 16 to 17, it went to from 33 billion to 38 billion, a little less than 20%. Where this year went from 38 billion to 40 billion, less than 10%. So gross profit has not increased a lot. Then finally we're going to look at net income. This is the money left over after everyone's been paid. And net income 17 to 18, I like how we have a nice jump, about 50% increase in net income. So if we're just looking at income statement alone, I still wouldn't be able to say a buy or a sell. I'm not liking the revenue increase as well, the cost revenue increase, 1-to-1 ratio, and I'm not liking how slow the cross profit is between these two. So let's take a look at something Lazy FA calls red flags. We'll open this in a new tab. So this is just another way to see some of the information we just looked at. So we can see annually revenue is increasing. Right, revenue is a lot higher than cost of revenue, which is pretty good. But out of all this revenue, the gross profit has not. Gross profit is actually pretty crazy. So this is actually looking at price to price ratio. It has it's a really great thing. Right, company is gross profiting about 40 billions. But then we can see here, where can we see? But then let's take a look at the income, at the net income. The net income out of those, out of that $40 billion, they're only keeping about 10%. So that's to me not that great of margins. But their net income has increased percentage wise, which is good to see. But to me, I'm still not 100% sold on FedEx being a buy. So what else can we look here? Like I mentioned before, revenue, the cost of revenue has been increasing. Revenue last year increased by 19%. Cost of revenue increased by 27%. This year, revenue increased by 8%, 8.5%. Cost of revenue increased by 11%. So right now, it does seem like cost of revenue is increasing dramatically compared to revenue itself. So next, let's take a look at the balance sheet. At the balance sheet, this is where we're going to look at total assets. So this is all the company's equipment, plants, inventory, if it has any. Liabilities is all the payables that included both short-term and long-term. Total debt's all the loans it owes. And the other one I like to look is cash and cash equivalents. So let's look at total assets. So total assets has been increasing throughout the year, so that's good. The company has more assets. But in 16, 17, and 18, the company received increased its liabilities by about from 21 to 32 by about 50%, and it has not dropped it down. It's actually been increasing little by little. So on 16 it was 32.2, and 17 it was 32.5, and now it's 32.9. So liabilities has been increasing as well as their total debt. So the total debt is about 17.14 billion. So they do have a lot of things they have to pay off. From their total assets, they have 52, liabilities 32. So share equity holders should have about 20 billion, which is not ridiculous. Cash and cash equivalents. So this is whatever the company has in cash or any assets that can be sold at such a quick rate that they could be considered cash just because they can be liquidized that fast. It has about 3.2 billion. It's pretty low amount of cash, billions compared to its debt. I'm gonna take a look at the red flags real quick to see how this debt is distributed. So for me, balance sheet, it's not looking too good in my opinion. Let's take a look here at red flags in balance sheet. So here again, we get to see assets and liabilities. Like I said, one thing I don't like is how liabilities has increased dramatically since 2015, and 16, 17, and 18 has been pretty flat line. Actually been increasing very has been increasing still by some 100 millions. Total assets has been increasing as well. Shareholder equity, like I mentioned, is the difference between the two. So right now we have we have a positive shareholder equity, which is really good to see. Then this is one thing I want to take a look at. So is asset distribution. Let me just first take off everything. Well, let's just keep everything here right now. So the total asset distribution, which was about the 52 billion, 60% of that is cash, is property, plants, and how is that 60 billion? Sorry guys, give me 1 second. There we go. So 60% of it is property, plants, and equipment. So it's probably older trucks and other facilities. Let's see what else is there. So here we can see that the main cost of driving up this asset distribution, this asset, is the property and plants and equipment. We can see from 2015 it went from 20.8 billion to 24 to 25 to 28. So this is the part of the asset attribution that has been increasing the most. So inventory doesn't have that much inventory, which is good to know. I wouldn't know what FedEx has as inventory, maybe boxes. Cash and cash equivalents doesn't look bad. Current investments, receivables. All right. Now here's the liability distribution. So we can see that current debt right now is about 502 million. Remember, current debt is that needs to be paid off within the next year. So we have about $3.2 billion of cash and cash equivalents. So we have enough to pay that current debt. Non-current debt is about 2.1 billion. Um, sorry, I was looking at some other. I was looking at some other year. So let's make sure we're in 15. So current debt right now we have 1.34 billion. That's a dramatic amount compared to its cash and cash equivalents. So remember, not all of this is cash. Some of this are just stocks or some other form of quick liquidizable assets. So for it, current assets to be that high, current debt to be this high, it's kind of scary. So to me right now, FedEx is looking like a pass. Um, Non-current debt of about $15.7 billion. And finally, the last thing we're going to take a look at is cash flow. So it's just the only one I really care about here is net cash flow from operations. This means that they have some positive cash flow from their everyday business, um, which they do, right? They have about $4.6 billion of positive cash flow from operations. So let's look at an overview real quick just to let's see what we got again. Revenue has increased, cost of revenue has also increased. Gross profit is pretty good, but the net income it collects from that gross profit, I personally think is a little too low. So for me, based on income statement, it will be a pass. Balance sheet, this is where to me it's what made the decision for me. Total assets has been increasing, but total liabilities and debt has increased dramatically. And right now, the current debt is about $1.3 billion, 1.4 somewhere around there, and the cash and cash equivalents are about 3.2. So half of that current debt needs to be used for this cash and cash equivalents. So for me, and for that reason, I'm gonna say FedEx is a pass. I wouldn't touch this one right now. Um, I hope you guys enjoyed the episode. Like I mentioned, Lazy FA makes it so easy to look at all the information, which makes these episodes go pretty fast. I'm curious, would you buy or pass on FedEx based on the information we just saw? Also, don't forget to subscribe to get information and updates on new episodes. I'm trying to post daily, so make sure to leave comments. Give me some advice if you guys saw something you didn't like. Anyways, have a good night, guys, and see you tomorrow.